question
Yes.
about the.
Yeah. Yeah. Go ahead. We got to. We couple of seconds. We're trying to get every platform back live. Couple of seconds, and then Nelda's gonna have her question, and then we keep going. Like I said, guys. We have tea, hot ginger tea, courtesy Nelda at the office. If you want to come by and have some tea with us.
I have a question that I don't know.
Hold on, Nelda, because he's trying to make sure we are back live
Okay.
on all the major platforms. Once we are, he let us know.
Okay.
All right, Nelda. Well, hey everyone. I guess we are back. You're watching an overview of the big beautiful bill that we've put together a webinar. We have people on different platforms that are watching us. I'm just letting everybody know that we're back live on Facebook, Instagram, and YouTube. We have people on Zoom that are also watching. And now that we're back from into our webinar, Nelda has the questions. We'll take the questions and then we'll continue our webinar on the overview of the one big beautiful bill. That's what it is, the one big beautiful bill. Go ahead, Nelda.
My question pertains to penalties. Now, when you have penalties and you don't pay what the IRS is asking you to pay on time, now the penalties get to a point to where you receive a notice, and that notice has the word CIVPEN. CIVPEN.
CIVPEN.
CIVPEN.
Okay.
Now, when you get a notice like that, would that be a key word to tell you consult with an IRS advisor?
CIEPEN.
CIVPEN, CIVPEN.
Oh no, that's civil penalty.
Yes.
So practically, there are cases that are going to be criminal cases. There are cases that are going to be civil cases. If it's civil, practically you're always going to see that on the letter, just to tell you it's a civil matter.
Okay.
It's civil penalty. It's nothing criminal.
Okay.
You just got to do what you need to do in order to get right with IRS. That's pretty much all it's saying. That it is a civil matter, not a criminal matter. That's pretty much what.
Why didn't they just say civil penalty? They send you something that says CIVPN. Who knows what that means?
Civil penalty. Yeah, that's pretty much what that's pretty much
that
what
was
that
the question.
Is. Perfect. All right. So we're gonna continue talk now about the no tax on tips. This is the detail for you now. This applies for tax year starting 2025 to 2028. It exempt up to $25,000 in tipped income per year, okay? But it phases out. A lot of times people don't like to talk about the phase out component of a bill, but meaning at some point you start losing that deductions or until it phases out to zero. The other thing you need to know is that tips must be reported to the employer, and the employer must report it on your W-2 to qualify for the exclusion. So don't say that I work somewhere and you get the tips and you don't report it in your W-2, boy. Okay? So that means you're not reflecting it in your W-2. Therefore, you're not gonna be able to take that exclusion when you come to me and you come and say, hey, I heard there's no tax on tips, and I'm gonna say, let me see your W-2. And then when I look at the W-2 and I don't see it there, and it's gonna be hard for me to qualify you for the exclusion because it has to be reported. And also, tips are still subject to payroll taxes, okay?
Oh my God.
Still subject to payroll taxes. You could still say there's no income tax, fine, because they excluded for you, is no tax on it. But obviously the way they put it, you would think there's no tax at all.
Right.
Right? But that's not the case because you do have payroll taxes that apply to it. Okay?
So it all rolls into one?
What it is that there are different types of taxes. There is the income tax, there is the payroll tax, and there's also self-employment tax, different types of taxes. So you got to look at the categories on there. No taxes on tips. I'm going to keep moving to the no tax on overtime because we're a little bit behind. I'm just going to speed it up just to talk about these sections and keep it moving. Personal tax changes on the one big beautiful bill. No taxes on overtime. Now, overtime is tricky, the calculations. Whenever people hear they say that, you would think it's all overtime that is not
No tax.
no tax, but it's not true. Okay, only the premium portion of overtime paid at 1.5 your regular rates under the Fair Labor Standards Act is eligible. What does that mean? For example, if your normal rate is $10 per hour and your overtime rate is $15, the extra $5 count, not the full $15. Okay, so again, it's only the excess over your regular pay that is considered a premium or excluded from there. Okay, so I don't know what this thing
Put
is
no.
asking.
Put cancel.
The problem is I don't have control over that. Let me see.
Tap on the computer, on the laptop.
Okay, so practically it's only the premium or the extra $5 that's there. Overtime mandated by state law, contract, holidays does not qualify. So again, it's not to say all overtime has no tax. So we got to be very specific, and that's why you got to speak with somebody who knows and understand it to be able to tell you that. Okay, and also they have a maximum deductions that you can take up to $12,500 for single filers and $25,000 for married filing jointly. Applies to both employers and self-employed individual reported via W-2. Okay, only those with a valid Social Security can file if married filing jointly. Okay, if it is an above the line deductions, which is good, it means it doesn't have to go through your Schedule A. You can do a straight deductions in your 1040 and be able to take it. So taxes on overtime. Let's keep it moving. SALS deductions. For those of you who pay sales tax on any and all items in the state where you pay sales tax and pay property tax, it used to be capped at $10,000, but now they increased it to $40,000. That means if you get all of your sales tax receipts and you calculated all of it, and it amounts to more than $10,000 or up to $40,000, then you can say, you know what, I'm going to itemize and use the sales tax deduction, because it's going to be definitely, your itemized deduction is going to be greater, because that portion of the deduction is not a straight deduction into your 1040. It is part of your itemized deductions. Therefore, you got to include it into the Schedule A, where you do your mortgage interest, where you do your property taxes and charitable contribution with churches, and total all of that. If it's $40,000 or more, obviously you that's the maximum amount of sales tax and property taxes that you can take and include that in your Schedule A, plus the other one that you have. So likely if you someone who have all of that property tax and sales tax, therefore standard deductions may not be the way to go. It may be best to itemize in that case. Okay, for that's just so you know. Credit for child tax credit penalty permanently raised. You know, the credit increased from $2,000 to $2,200 per qualifying children under the age of 17. And this amount will be indexed for inflation in the future. So practically, this amount is going to continue to change as it's indexed for inflation. As inflation is adjusted, it's increasing, so will be this amount. That's pretty much what I want you to know there. I'm trying again to keep this at a high level, and then if you want specific, you can always call back the office, and I give you the number from the beginning with the housekeeping items. Feel free to reach out to us. Our office is right here off on 111 773 Northwest 111th Street. Feel free to come and talk about your specific facts and circumstances. They may differ from someone else, so we can help you with whatever questions that you have. Again, the phase-out structure of remains unchanged and is permanent under OBBD, one big beautiful bill. So that's important for you to understand. Here's one of the favorite topic that I want to talk about here. It's the earned income tax credit. The earned income tax credit. The earned income tax credit is a refundable credit that reduces tax liability for low to and moderate income workers. The amount of the credit depends on earned income, filing status, and the number of qualifying children. Somebody at the door. The amount of the credit depends on earned income, filing status, and the number of qualifying children. So for 2025, the maximum credit ranged from $649 for taxpayers with no children to $8,046 for those with 3 or more children. So that basically gives you the maximum amount of credit that you can get versus the maximum amount of income that you can get. In the next slide, I'm going to show you income limits determine eligibility and the phase-in, phase-out structure shapes in the credit curve. So the first slide that you're looking at here, right? So you can see for the earned income tax credit, 2025 tax filing file 2026, what does it show here? It shows the maximum amount of income that one can earn per category, okay? Single, head of household, or married filing jointly, the maximum amount of income that you can earn and still have some type of credit for the earned income tax credit. For example, if you have no children and you're single, up to $19,000, you're gonna get something. I'm not saying it's gonna be the maximum amount because we then would have to look at the EIC table to be able to see exactly what is the amount that you're gonna get. If you have one child and your income up to $50,000, you will get something. It may not be the maximum amount, but you're gonna get something. To know exactly how much you're gonna get, you definitely gotta go back to the table. So what does that also mean? That also means if you make over $50,000, you hear the word? Over $50,000 and you have one child, then you are not going to get any EIC. So what people do usually in this situation, when they go to file their taxes, they say, I see a sign on the road that says, I'm going to get $8,000. But what they're not getting or understanding is that that $8,000 is for you have to make a specific income to qualify for that. It's about requirement and eligibility. You may not be eligible for it, right? But then if your income exceeds a certain level, you're not going to get anything at all. Right? That's what we need to get accustomed to. That's what we need to understand when it comes to the EIC. So again, what people do, they try to beat up their income to file some types of Schedule C, ensure that they have a business, they have a bunch of expenses, they have a bunch of losses to lower or offset the income that they have. As a result of that, it put them in a category now where they can qualify or feel eligible for the earned income tax credit until they have an audit with IRS. So here is the graph that we put together just to look at the different level and the maximum amount of credit that you can get. I wish I had more time, then I would go to the actual EIC table to kind of like show you based on your income how much of the credit that you can get, but practically I'm only showing you here the maximum that you can get based on the number of children, based on the filing status, and based on the maximum amount of income that you can earn. To be more specific, again, you got to go to the IC table to figure this out. So we're gonna continue to jump onto something else. Any questions on the EIC, because I know that's a favorite topic for a lot of people. Let me take a minute here to assess and see if people have any questions there. Go ahead. Nelda?
Do they don't have? I want to know, why is it so difficult for us, people like me in my days when I only had one child?
Right.
I've only had one child all my life. Why is it so difficult for them to take care of us with just one child?
Well, believe it or not.
Only because of the fact that if I make 50 grand a year
Right.
and I'm raising this boy, I don't get nothing.
Believe it or not, they always measure this on what we call affordability and safety net for the poor, right?
I'm poor.
Yes, I understand, but the income level is what they use to determine these kinds of things, right? If for whatever reason they have something called a poverty line study.
Right.
I think immigration have their table, IRS have their table based on the household size and all of that. So they determine the poverty level based on some numbers, some statistics or whatnot to say, okay, if your household is 4, 3, 4, and if you're making such amount of income, therefore you're not considered that. So that is one of the reasons why in this bill, one of the things that you're trying to do is make it indexed it for inflation, right? As inflation increases, therefore you're going to see some of this amount increases. So at the time that you were filing, these were the statutory number that everybody was looking at the time. So if you make even when filing for food stamp or for when you try to do file for financial aid, right? So they're basing these numbers off this poverty line guidelines, and if you above it, you basically not gonna qualify.
That was another one. I never qualify for food stamp, and I never get it.
Well, again, it's the income level that you get. Now,
it's just not fair.
I'm trying to test with you guys that are following on the Zoom. Or do you have any questions as it relates to the earned income tax credit, the no tax on tips or overtime? So before we move on to another section, again, it's a webinar. We take pauses and we keep going because if the time permits, if there's any questions, we'll take the time to answer it. All right, I guess we're gonna go right back to the presentation. Give me 1 second. Let me try to bring it back up.
And see, they're missing out on the ginger tea because guess what?
Yeah.
We got some takers on the ginger tea.
Absolutely. So Nelda is saying there is ginger tea here as well. Thank you for stopping by and get your ginger tea and be part of the webinar.
We've been listening.
Yes.
We heard come back the ginger tea.
Oh, yeah.
The salad is in the refrigerator.
Thank you very much. I appreciate it. I appreciate it. All right, guys. So let's go on to the next slides. Let me make sure this works. Okay. Now let's talk a little bit about car loans and interest deductions. We used to have that deduction a few years back, maybe 4 or 5 years ago, but the OBB sort of bring it back. If you have car loan interest for a new passenger vehicle like a car, SUV, pickup, motor vehicles, assembled in the U.S., has to be assembled in the U.S., no foreign cars, up to $10,000 per year in auto loan interest, you can deduct it. What's good about this deductions that I like is that it applies as an above the line deduction. So you can claim it regardless of whether you itemize or not. So every time you hear it's an above the line deduction, it's a good thing. That means in addition to your itemized deductions, or you don't even have to itemize in order to get the deduction. So up to $10,000 in auto loan interest, you can take a deduction for it, and it's an above the line deduction. So for those of you who have cars, business cars, that is, okay, new passengers vehicle, well, actually they do it for both personal and commercial, and no commercial vehicle, because this one deals directly for personal exemption. So this one would work directly for those that are personal vehicle as well. So I rephrase that, okay? Up to $10,000 per year in auto loan interest, you can deduct for your personal car 2025 to 2028. So that means after 2028, you're no longer gonna have that. So there is a phase out component. A lot of times, like when I talk about taxes and I bring the phase out component so people understand, up to a certain level of income, again, Nelda, you are not going to be able to take the full deductions because your income, so-called income, right, exceed the threshold. So it phases out. So we're not gonna go into the specifics as to what amount is considered phased out. So let's go now talk a little bit about the Trump accounts. So you hear a lot of people, this is one of the change that's creating a lot of buzz right now. Okay, so the Trump accounts, okay, one time $1,000 deposit from the U.S. Treasury into a new Trump account for each U.S. citizen newborn born January 1st, 2025 through December 31st, 2028. I'm pretty sure there's going to be a lot of babies, right? I am pretty sure there's going to be a lot of babies, right? So, it does not only stay there. So we'll talk a little bit about some of the eligibility, the contributions, who can contribute and stuff like that. Child and parents must both have valid social security numbers. Child must be a U.S. citizen under age of 18 in the year the account is established. The account is custodial, controlled by the parent or guardian until the child reaches the specific age, and so on and so forth. So, who can contribute? Annual after tax contribution, parents, relatives, friends, up to $5,000 per year, indexed for inflation. So now I'm pretty sure when we go through these baby showers and stuff, people are gonna be donating to your child Trump accounts, right? Investment accounts. And that would be a great way to gift the child. Also, employers, people where you work, they will consider making contribution to the Trump accounts for your child too, up to $2,500 per year, also indexed for inflations. Must be invested though in a low-cost U.S. equity mutual funds. They're still trying to structure this, and like the Charles Schwabs and all these money manager companies, they're gonna be able to create those accounts and facilitate you to open those Trump's accounts, and where you're gonna be able to have $1,000 from the Treasury and also contribute to your child investment account. And I'm sure once the child reach 14, 18, 16 years old, they're gonna be very happy to have that money waiting for them. Earning gross tax deferred until withdrawal, so there's not gonna be any tax on the earning until withdrawals taxed based on the contributors, right? $1,000 seed employer charitable contribution are treated likely like the traditional IRA, like we normally do it right now. Withdrawal for qualified use, education, home, business are penalty free, but income tax still applies. So that's something for you to consider. Now we're gonna do a little change where we're gonna talk a little bit more now about the business changes. From the business perspective, so we kind of like almost done with all the personal changes that we needed to lay out for you. Talk about the earned income tax credit, talking about the child tax credit, talking about the Trump accounts, the no income on overtime, on tips, right? So now we're gonna talk a little bit about the business tax changes. I don't know if we want to take a break because I feel like I need a sip of that ginger tea.
I've been sipping.
Unfortunately, you guys are not at the office to enjoy that beautiful, that tasty ginger tea that we have going on here. You see people coming in and out of the office just to share a little bit of the tea.
Perfect weather.
So we're gonna, and it's really cold out there, and I'm glad people are watching. They're asking questions, so I'm gonna come back. We're probably gonna take a 5-minute break and come back before I go into the business tax changes. So what time is it? So we're about 38. So we're coming back in about 45. Okay, 9:45. We're gonna be on pause, bus man. Try to pause it. All right, guys. So we're gonna take a 5-minute recess. We'll be right back because we started a little late. So we'll just gonna try to run through the business changes, and we'll be back while I'm trying to enjoy a little bit of the ginger tea. All right. In the meantime, those of you that are on Zoom, if you have questions, put your questions in the Q&A session, and I'll be able to answer them for you once we come back.